Morning, everybody. Happy Tuesday. I am here with Don Garman and Jonathan Ting. We just got out of another great investment committee series of discussions, and so thought it would be a good time to check in with all of you and let you know what is on our minds. So, Jonathan, let's start with you. Markets have been moving quite a bit the last couple days. Um, Rates are creeping up like we've been waiting for. What are you watching right now? What are you thinking about going forward?
I think in today's environment, the thing that all investors need to watch for, what we're watching for, and I think maybe the only thing to be watching for right now is the direction of yields. And on the long term, the 10-year, the 30-year, how inflation expectations are moving. Because given the environment that we are in now, coming out of 2020, where valuations for equities are so high, borderline unexplainable, where credit spreads are so low, priced to perfection, and everything is priced so perfectly, so high, you really have to look at the alternatives in the market. Now, before in 2020, there was no alternative. There was only you get in at these high valuations or you lose. But now, as yields move up, it's providing the market with alternatives. And as those alternatives become more attractive, it, in a relative sense, makes equities and credit spreads look unattractive. And I think that's what we're seeing these past few days. Where the 10-year basically skipped the 1.2% range on the 10-year. Really, it went from 1.2 straight up to almost 1.4 now within a matter of 2 weeks. So that move is pretty drastic, and I think we're seeing the effects of that in the market these few days.
So, Don, we talked about how basically everything that worked last year is no longer working this year, and the things that didn't work are now working. And I know we've reflected some of that in our main core investment strategy, the Longview strategy. Can you give us your thoughts on that?
Yeah, I said, glibly when somebody was asking about the uh, additions we made in December that, in some sense, we were partying like it was 1999. Those were stocks that somewhat had been left for dead over the last 2 decades. I'm going to make a point that I made in committee that I'm going to just share with anybody who cares to view this, which is I think one of the very interesting um, uh, things to watch for is if you think through the narrative, the sort of pandemic shutdown, people at home, democratizing investing with Robinhood and whatnot, and certain segments of the growthiest parts of the market really performing well, and people buying into and benefiting from that kind of that YOLO mentality. Um, we talked about those of us who remember the sort of aftermath of the run up in 99 to 2000, you know, that whole, sandcastle had to get not only demolished, but sort of washed back out to sea over another 18 or 2 year period. And so, what will be really interesting to see is as rates do start to rise and we are getting kind of this reopening, you know, uh, surge. And I think we're even feeling and seeing that things are happening maybe even a little faster than a lot of people were predicting in terms of reopening the actual economy. Whether or not some of those investors that are kind of new to the game, when they're starting to get beat up on a little bit and demoralized by how this can appear to be easy over certain periods of time, and then you realize over longer periods of time maybe it's not so easy, whether that kind of unwinds, and if it becomes a more prolonged and painful process. So it's certainly too soon to say. We're not, and like I said in the last video, I think we're not drawing any massive conclusions about this. But certainly, when all of the elephants are packed into the same 2 dozen or 3 dozen stocks, and then they all decide they want to leave out of the same door, that stampede leaves a lot of bodies strewn all over the place. So anyway, we're trying not to be among them, which is so far so good. But and not we're not rooting against anybody. We're rooting for everybody, but we're rooting for us and our clients more than everybody else, for sure.
Well, I think the decisions that came out of our meeting this morning is to um, trim some of our winners, but also focus um, on having a little dry powder to take advantage of companies that we do like in case this correction continues. So
Yeah,
that's
I think Jonathan had a strong point that I will not take credit for, but I will reiterate, which is we have a couple of positions that have been the beneficiary of this euphoria among, this sort of SPAC angle of the market. And what we've been seeing really strong evidence of the last few days is that when these deals actually get announced, very often they disappoint whatever expectations had been baked in. And so I think, you know, to take advantage of some of our good fortune and good timing and dip toward the door now, I think might make some sense. So we're going to do that. And like you said, Lauren, look at everybody has seen what happens. Sometimes we'll buy something, and if it goes down, we'll add to it. Sometimes, then it goes up, we take a little off. And in this case, we had something that I took a little bit off last week or the week before. I wish now looking back, I'd have taken it all off, but it leaves so little left that it makes sense to just go ahead and get rid of it and keep the powder dry. And I think it's right. Get ready for a reset because I think one is coming.
Jonathan, what are you looking for in the aggressive growth strategy?
Well, the MAG's strategy right now is pretty heavily concentrated in some positions that we like, as a sort of derivative play against this maybe correction that Don was talking about. Over the past few weeks, we've been concentrating in the stocks we like and cutting the number of positions and the smaller positions to sort of reduce our overall market exposure. Unfortunately, that hasn't worked out well this past few days. With this rotation, and some of the companies didn't perform as well after earnings. But these companies we all like. I try to keep them somehow in play with the reopening theme. So while they're all still heavily in the tech sector, if you look at the holdings and the end markets that they sell into, a lot of them sell into that reopening trade. So while they may, the way I look at it, while they may trade like SaaS stocks and the Qs in the short term, over the medium and long term, we should see them benefiting from that reflation trade. And the way I see it, with this coming reopening thing, and why I'm not moving out of software stocks and all into energy or all into industrials at this moment is because I think the reopening trade is very hard to quantify. I think if you look at something like the mega cap stocks and their valuations are going higher, well, those companies are very large and their markets are really understood, and analysts can really quantify what the future of this business can look like now. It's not like the 2000s where it's like, oh, it's internet. Well, how big can it be? Nobody knows, right? And now you look at a company like Apple, pretty clearly how big it can be, and you can push that valuation higher. The flip side is the reopening trade is sort of like tech in 99, where I feel like you can't really quantify what reopening means, right? Okay, things reopen, people go out. Well, how many people are going to go out? How many people are going to take that vaccine? What is the effect of that 1400 stimulus? Nobody really knows. All they know is things are reopening. It's going to be great. So just like Don said, while there was a rush to the tech side, there might be a rush out and into this reflation trade like we're seeing these few weeks. But I would be careful about diving in, head first all the way into this thesis.
Well, and the other thing I'd add, and I think we've talked about this before on the videos, but we have been adding to VIXI, which you talk about like an insurance on the market, and looking to buy it when the markets were quiet and stable and boring and it was cheap, and that's been paying off well this week. So
yeah, I can speak to that a little bit. I had written a small blog post last week about some of the best ways to sort of hedge your portfolio or sort of pull back on risk when we're in an environment like this. And in my opinion, it's really important to buy insurance. Because when things are so high for no reason, well, then that means there's no reason they can't go higher. right? So you have to protect against that risk as well. So the best way to do it is to buy insurance, because when things are going up, nobody thinks about the downside, and insurance becomes very cheap. So we have a significant amount of insurance in ags. We have a lot in MLS too. This week it's been holding in, but those really won't help with the short term moves in the market. I still see these past few days as pretty short term. We haven't broken any big trends. I mean, the S&P is not even below its 50-day moving average. But if things do get funky, like Don said, those will start to come into play. I think, and they'll be really helpful.
Mhm.
Well, I would just say, and I think we can conclude on this note, this was, and I enjoy our investment committees all the time, but this was a good spirited, impassioned debate. And so I think we're all a little more tuned to what is happening right now, which I think is a good thing. So is that fair?
Yep. Great.
Well, shall we conclude on that?
I think so. Thank you,
All
everyone.
right. Well, thank you, everyone. As always, we appreciate you. And if you have questions, please reach out to somebody and ask, and we will do our best to get you answers. All right. Until next time. Bye.